Time series analysis is an important subject in finance. In this post, we are going to apply a time series technique to a financial time series and develop an investment strategy. Specifically, we are going to use moving averages to trade volatility exchange-traded notes or ETN. Moving averages are used on financial time series data to smooth out short-term noises and identify longer-term trends. We apply them to VXX, a volatility ETN. Note that VXX was launched in 2009. Enables investors to bet on the size of swings in the S&P 500 index, SPX. Used by individual investors and hedge fund managers alike. Peaked at $2 billion under management in February 2018, now $800 million. Structured as a debt instrument with a maturity date of January 30, 2019. It was replaced by the VXXP, which has other features. The trading rules are as follows. If 10-day moving average less than 30-day moving average, sell short. If 10-day moving average greater than 30-day moving average, cover short. The system is implemented in Python. A graph on our website shows the moving averages and VXX for the last 2 years. The position size is $10,000, leverage is not utilized, and profit is not compounded. A graph on our website shows the equity curve for the trading strategy from January 2009 to January 2019. The strategy is profitable, and the moving averages help identify the trends. Go to our website to download the Python program and data file.